Good afternoon and welcome to another edition of Money Matters. My name is Dan White. I am the host of your show today. I'm also the president and CEO of Dan White and Associates. We are a retirement planning firm. We're headquartered in Glen Mills, Pennsylvania. We have two satellite offices, one in Middletown, Delaware, and we just opened our third office down the Delaware beaches in Lewis, Delaware. And we work primarily with people that are getting close to retirement or those already retired. And I guess the big question in our industry is this stock market just seems to just have legs that just aren't going to end. It just, just keeps going up, up, up. And kind of gets you a little worried because when it goes up as quick as it does, it's kind of reminiscent of, the dot-com bubble in 2000 and the real estate bubble in 2008. I mean, we came into this year, everybody was kind of predicting a recession, a hard landing. The Fed said they were going to reduce rates quite a bit, and they have not. They finally did initiate a rate cut last month, and the market really loved it. The market hit an all-time high. It settled back a little bit, and now today is going to be, it looks like, at least up until 4 o'clock, we're going to have another all-time high today. So the question is, how high can it go? And I'm not sure. I mean, I'm kind of surprised. We've had the year that we've had. The market's up 20%. And if you look at the valuations, the valuations of the stock market, I would say probably 21 out of 22 metrics that we use to gauge the how expensive the market is, they're all at all-time highs. So history or research has shown that when you get in the market at these elevated valuations, your returns over the next 5 to 10 years are generally not good. So I think the moral of the story is if you are near retirement, if you're within 3 to 5 years of retirement, you have to be a little more cautious because we get into the sequence of returns risk, which generally means if you suffer a downturn right on the cusp of retirement, the odds are pretty good that you're going to run out of money. I came across a statistic the other day. If the first year you retire, you're down 10%, your failure rate goes up to about 15%. If you're down 20%, it goes up to over 30%. And if you face a 30% drop in the first year of retirement, your odds of running out of money are over 50%. So with valuations being where they are in the market at all-time highs, I think you do have to be a little bit cautious as to where you're at with your money today. And then there's a lot going on. I mean, we have two wars being fought, the Mideast and Ukraine, Russia. The Mideast is kind of escalating a little bit. We still have inflation. I don't think inflation is licked yet. I think the Fed is cutting rates, which means inflation could rear their head. The Middle East conflict could impact the price of oil. And we've got an election. We've got an election in a month. And, I hope cooler heads prevail, but will we know who won the election on election night? I'm not sure. And I worry that the country could get rambunctious and who knows what could happen. We've seen in the past where things don't go people's way, they tend to act out. And we've seen cities burned and looting and that type of thing. So hopefully we won't see that this time around. But when you have all these volatility factors, along with the fact the market's at an all-time high, it would not take a lot to tip it over and send it into a tailspin. So I think the moral of the story is if you're near retirement, the market's at an all-time high, it may not be a bad time to think about taking some of that risk in your portfolios off the table. So that's my personal outlook, and hopefully you gain something from that as well. We're blessed today to have a co-host. We have Jeff Watkinson on from Watkinson Capital Advisors. Jeff, welcome to the show.
Hey, Dan. Great to be with you. Thanks for having me on.
Yeah, it's great to have you. And I know, Jeff, you work in the muni bond sector, and we don't do a whole lot with muni bonds with our clients. I mean, we work with guaranteed income quite a bit. But so I'm interested to hear what you have to say. And I think I kind of preluded to this when we came into 2023. The Fed had gone out on a limb last year, and they were predicting 6 or 7 interest rates cuts throughout this year, and so far we've had one. So how has your firm been positioning your muni bonds for current investors, and new investors? And how are you structuring portfolios today?
Good question, Dan. Yeah, at the end of last year, the end of 2023, as you said, pundits and strategists were predicting 6 or 7 rate cuts into 2024. And we've been firmly in the one cut camp because our senior partner, founder of the firm, was around in the 1970s and was around the 1980s when we had enormous inflation. And, inflation is really tricky once it gets out. And it just seemed unlikely that this was going to happen. It seems like we've gotten a better hold on inflation recently, but really the way we're positioning bonds is dictated by the shape of the curve of rates and where yields are. And heading into this year, we were seeing, I'm going to do a little visual here with my hands, in the short part of the curve, going out 5, 6, 7 years, yields were higher. And then down in the belly of the curve, maturities longer than eight years, going all the way out to 15, 20 years, yields were lower. And then beyond 20 years, yields got higher. So we were using a barbell strategy to give investors exposure in that 5, 6, 7 year range, in investment grade bonds, A-rated or higher, earning 4% or higher. And then we were really looking out towards new issue municipal bonds with 9 or 10 years of call protection and, really going out 20, 25, 30 years in maturity, which is the longest we've ever gone out. And the reason we went out that far was because of the yield pickup. And we've seen the best yields in Muni land in over a generation. And we have to go back beyond 2007, 2008, to see these types of yields. And for an investor to be able to lock in 4%, a tax-exempt yield, with 9, 10 years of call protection is enormous. We've had clients ask for 20-year non-call paper, which is hard to find with municipal bonds because most bonds have call protection, which allows the municipal authority, state and local government to refinance, call the bonds and refinance if rates are lower. So we've been extremely active in trying to use that barbell effect. And it's all dictated by the curve.
Yeah, it's kind of interesting, Jeff, when you talk about the yield curve. We were inverted, and we were inverted for the better part of 2 years, where the short-term rates were higher than the long-term rates. And that's not a normal type of situation. And history says that there's a recession coming right after that. The Fed started cutting rates, the yield curve uninverted, and everybody thinks rates are coming down, and now the long-term rates are starting to head up again. So it's not helping people from a mortgage standpoint or an auto loan standpoint. But describe the characteristics of investors that you work with that are committing a portion of their capital to tax-exempt munis. Why are they investing in 2024? And where's that money coming from? Where was it before?
Great question. I mean, we're looking at people who are in cash, they're in money markets. The term T-bill and chill, when 6 months ago, a year ago, you were able to get 5% in a 2-year U.S. Treasury, a 1-year U.S. Treasury. We see people, those bonds coming due. Our investors, the investors we talk to are smart, they're intelligent, they read the Wall Street Journal. They understand that these are the best yields they've seen in a generation. We've seen a lot of money matriculate from municipal bond mutual funds. There's pitfalls in owning mutual funds. Your capital is at risk to the buying and selling behavior of the other investors in the fund. And, we're utilizing the separately managed account format. And that's where we're seeing the money locking it in, locking it down, locking in that 4% yield in investment grade municipal bonds.
Yeah, it's true. I mean, we haven't seen these types of returns. And let's face it, the Fed was keeping interest rates at zero for, the better part of 15 years. We were scrambling, no yields anywhere. And And now we finally get some yields, for a couple of years, and now they're talking about cutting again. So, it is a great time to lock in on higher yields if you can maintain that. So what have you really learned in 2024 about muni bonds in the marketplace, and where do you see rates heading?
Well, some of the things I've learned is election years are different. We have November 5th coming up, our election, and the new issuance market has been absolutely robust this year. And it seems like most municipalities and state and local authorities are, straightening out their finances before the uncertainty. I mean, it can be boiled down to as simple as deal with the devil, and everyone is rushing to market, and we're seeing a lot of opportunity, new deals being priced to sell, which means low price, higher yield. And the question is, can you get bonds?
Yeah. So we have a question from our audience here. Ronald Gates out of Boston says, what areas of muni bonds are providing the best returns at this time?
Ronald from Boston, great question. There's more value, more yield in longer maturity bonds, and especially bonds that are being issued in the primary market, new deals. Like I said, they're priced to sell. So if you can get a bond, an investment grade muni with 9-10 years of call protection that goes out 20-25 years, and you're locking in over 4% for a Boston, Massachusetts resident, a Massachusetts deal. Massachusetts is a high state income tax, and to be able to achieve triple tax exemption on the income you derive from your Massachusetts bonds, you're looking at nearly a double of what the nominal yield is. So 4% is roughly equivalent to an 8% tax equivalent yield.
Yeah, I think that's the key when you're in those states with the high state tax rates, and there's a lot of them. I mean, that's where muni bonds really can come into play. So, Jeff, we are fortunate. We are going to be joined on the program today by Tami Fratis, ACT Capital Advisors, and Tami is coming to us from down there in Tampa in the eye of the storm there. Tami, welcome to the show.
Well, thank you, Dan. I love being on this show. I used to host it back in the early 2000s, and I'm excited to be a guest today.
Well, it's great to have you on there. I hope everybody's staying safe down there in Florida. You guys are getting hit with a double whammy down there.
Yeah, we have Milton visiting after Helena.
Yeah, you're having a lot of company.
Be safe, Tami.
Yeah,
Thank
be
you.
safe. Well, Tami, let's get into your business a little bit. You're kind of working with kind of selling business and stuff. How does a business owner raise capital for growth from non-traditional sources, like not from banks, but from family offices, high net worth, or venture capital?
Sure. That's a great question. I would like to say, Dan, just like the public markets are frothy, and we always ask, like, when's it going to stop? The private markets are the same way. So if you're a business owner and you're thinking about retiring in the next year or so, valuations are at an all-time high. Multiples are at an all-time high on earnings. And now's the time to start preparing for that exit before we have a downturn. So to get your business ready, you really need to put together an investor deck. It's usually called a pitch deck. It's about 10 to 12 pages to summarize your business. But more importantly, your team needs to have the same elevator pitch. So the whole team needs to be saying the same thing when they're out in the market talking to potential investors. You don't want one person saying they're selling computers and another person saying, oh no, we're selling phones. You want them both to say, we're Apple. We sell innovative products that are designed for our customers. End of story. It's a brand, not a product.
Tami, I got a question for you. I mean, you're helping you're looking for business owners who are looking to exit. You're in the advisory business. You're helping them transition, prepare their company for sale. Say it was me. Who would I have to hire? what would I have to do first to really make sure I'm going in the right direction, or the right advisory team around me to
Sure.
prepare?
Great question. So first and foremost, you have to get some audited financials. So you need an accountant, a CPA from a legitimate firm so that you can have 3 years of audited financials. And ideally, you really want a quality of earnings. So it's not just about, yes, I've been audited and the CPA says it's my opinion that the audited financials are prepared according to GAAP, but you want to also say, I've ripped apart the financials and these numbers, you can hold water in these numbers. There's no funny business going on. You all,
Go ahead.
Dan.
I was going to say, Tammy, do you find that happens a lot, that somebody might be cooking the books, so to speak, or making the business look a lot more attractive than it actually is for sale?
Well, here's the problem with small private businesses, right? A lot of things get passed through as expenses. So when we talk about selling businesses or raising capital for businesses that have more than 2 million of EBITDA, we say more than 2 million unadjusted EBITDA, because once you start to take apart the numbers, you say, oh yeah, the boat expense isn't going to be part of the business expense going forward, and the car expense isn't going to be part of the business expense going forward. The New York apartment for the theater and the theater tickets, or the Giants games, or the San Francisco 49ers games, all not going to be part of the expenses going forward. So we have to adjust the earnings to see what the business is really worth.
So Tammy, we need an accountant. We need 3 years of audited financial statements. Should we get an attorney?
Yes.
What other professionals should I be consulting with to start the process?
Well, you're right, Jeff. You're also going to need an attorney, because you're going to need someone who looks over not only our engagement agreement, but anyone's engagement agreement, the NDA. You're going to want to have someone sign an NDA so that your information doesn't get disclosed to the world. You're going to want to have either a stock purchase agreement or an asset purchase agreement or a convertible note going into equity or debt, a loan, a straight loan. So you're going to need a lawyer, an accountant, and you're going to need an investment banker to run a process to get the highest value. And you may need, depending on how much housekeeping needs to be done, you may need a consultant to help prepare some of the documents I mentioned, like the investor deck and documenting sales and marketing processes, operational processes, and management team assessments, so that the owner or the buyer can determine, yes, you have a secondary management team, that if you got hit by a bus, the company's not going to fall apart.
So another question there, Tammy. I was actually, I worked for an insurance, or I was an agent for an insurance carrier back in the late 90s. The insurance company got sold, and the buying company thought they were buying this distribution system. Well, when the sale went through, I'd say probably half the agencies flew the coop, and they went out on their own and went and made deals with other companies. So if you are purchasing a company, how do you guarantee that you're not going to lose, half the key people, or the the distribution system, or that type of thing?
Yeah, sure. It's a great question. And it's two sides of this same coin, right? One side is, how do I make sure I retain my employees post-sale? Well, one thing is, do they have a deferred comp plan? Do they have employment agreements? So they might have a 4-year employment agreement. If you sell the company, the employment agreement stands. Do they have non-competes? So even though non-competes have been done away mostly, it's still not a bad idea to make sure it's clear that they can't solicit employees or hire or take customers if they do start a competitive firm. So they could still compete with you, but they can't hire the employees from the firm, and they can't take customers. On the customer side, how do you retain those customers? Well, develop long-term recurring revenue or reoccurring revenue. So service contracts, or subscriptions. So you could get a subscription not only for your cable TV, but for a lawn service, for a house cleaning, keep cleaning service. You get a subscription for, the iPhones, right? A new iPhone comes out every 1 year, 2 year, 3 years. Well, that's a reoccurring, not a reoccurring, but the people are going to trade in their iPhone, right? It's addictive. So that's how you maintain your customer base, by making sure they're loyal to your brand, and by making sure, if you can, you contractually tie them to your company.
Tami, so I guess my question here is about timing, and let's hypothetical. I'm a business owner. I want to sell my firm. Is how much time? I mean, we talk about retaining key people, subscription models. How can we strengthen the business, recurring revenue? I mean, how much time should I bring in a consultant? I mean, is a year out too soon? Should I start planning this 5 years, 10 years out?
If you wanted to sell in 2025, let's say April timeframe, you should start ideally a year in advance. Tight would be 6 months in advance. But again, if you've done some of the prep work, so for example, if you have a second tier management team that allows you to go take a vacation for 2 weeks where you're not on the phone every day with the company and you're not still basically from vacation, then you can focus your time with a consultant or with your investment banker or with your lawyer and your accountant to get ready for the show. If you have even a sharp person who just graduated from business school or just graduated from a marketing undergraduate business program, they can put together investment docs and they can put together this document, the sales and marketing processes. It's amazing what recent graduates who have been in an undergraduate or graduate business school program know how to do.
It's interesting. Again, Jeff and I are probably looking at this the same way. Is I have my own business. Do we have other advisors? Yes, we do. We have 4 other advisors. And Jeff probably has other people as well. But if you're looking to sell your business, there's still those people that, they want to talk to the top guy, and that's a big part of the revenue is the top guy, so the top guy is trying to sell. How do you build that into the purchase price, the goodwill, the name, the brand? How do you deal with that?
Well, that is a phenomenal question, because a lot of times with the smaller businesses, that when I say small, I mean below 100 million, smaller businesses where somebody started in their basement or their garage and built the company to $50 million or even $100 million, that's still their baby. So they are still the kingpin and the linchpin to the success of that company. So that's why hiring a consultant or working with an advisor to document what works for the business, what doesn't work for the business, what is your secret sauce, because that's part of your valuation. That's part of the know-how. It's called internal human capital, and the internal processes that make you have a barrier to entry against other competitors. And so the other thing, if you sell to private equity, which there's a lot of money on the sides with private equity, they frankly don't like management to hang around the top guy. They want to bring in their own top people. And even though that doesn't work a lot of the time, it's how they do business. If you sell to a strategic buyer, which usually they pay out more money than private equity, not always, but more commonly, they want you to stay around to transition, and they usually work better with the CEO, the former CEO, to make sure that there's a smoother transition, because they want your business to be successful as part of their business.
Sure.
So that's usually how you do it.
Okay.
Tami, you've been doing this a long time. You've helped a lot of companies, a lot of business owners sell their business. I guess it's a two-part question, but what's changed over time with yes with the structure of the deal, and secondly, what are some of the common mistakes that you see business owners making as they prepare their exit strategy?
Sure. I'd say I want to start with the second part of that question.
Okay.
So most business owners have a number that they want. They say, I'm going to, take my toys and go home if I get 30 million, or I'm going to take my toys and go home if I get 60 million. And so they have a number. So we provide a free valuation to set expectations, because in reality, none of the precedent transactions or comparable transactions or the multiples that are in the industry, even though they're high now, or the discounted cash flow supports a 30 or $60 million valuation. So you need to know that up front, so people aren't hitting their head against the wall repeatedly, right? That doesn't work. So what can we do? Well, we can do a number of things, because now we know early. We can make an acquisition. We can launch a new product line. We can go into a geographic market that is not our current geographic market. So we can increase the size of the company so that the owner gets the valuation they want through non-internal growth or through organic growth by a new product line or a new geography. So we can do that. So that's one thing. The first part of the question, which could you repeat it, because now I got off on a tangent. I totally forget it.
I guess what has changed?
Oh, what's changed? Okay, that's right.
Like, are deals structured differently? Are there new?
Well, it's interesting because I have been in the private equity venture capital world since '93, so a long time. And even though there's a flavor of the month, like, we structure it as a safe transaction if we're raising equity capital, or we like convertible notes because we want to have our investment protected. So debt is obviously higher in a liquidity event than equity. So that goes along with the market. But right now, there's so much money out there that what's really changed is the market is frothy. There's a lot of capital by the sidelines, so the multiples are higher. We did a valuation on a company. I was just on a call this morning with the firm, and we got 50% higher on an LOI than we had valued the company at. So that's very unusual to go out to market and say, we think the company's worth 30 million, and we come back and get a $45 million offer by multiple people. Very unusual. And it's not going to last, unfortunately.
Well, that's not a bad thing. I mean, you've got me actually thinking about selling, Tammy, if valuations are that frothy at this point. Let's see how much cash is out on the street,
There's a lot of cash.
But I want to thank you both for being on the show today, Jeff and Tammy. It was really a pleasure having you on. And our next guest next week is going to be Nikesh Shah. He's an MD and CEO of Nearsome Laboratories. He'll be on our show next week. So we hope you enjoyed this edition of Money Matters today. I thought it was very interesting. And I hope you tune in next week to watch us again as well. Have a great day.